Hey there. Has the recent financial volatility really got you worried about your financial plan and whether you're going in the right direction? My name's Steve Larsen, and I work with people to help them create their financial independence. We want you to be abundant and live your passion and purpose. And so the thing we're talking about today is financial volatility. This is the third of 4 videos. If you want to go back and look at the other 2, I recommend that because they all build on each other. But today we're going to talk about how we start balancing out our allocations so that this financial volatility doesn't affect us and we can actually get down the mountain safely with money coming into our home and our household, all that constant cash. And so as we talked about, our objective is not just to get to the top of this mountain, it's to get down safely. We always want, on the Wall Street has programmed us, hey, we got to get a high rate of return going up to the top of the mountain because we're chasing these returns, which is arguable. And that's a whole nother sidebar conversation. But we also, if we're going for the 6 to 10 going up, we don't want to only go for 3 to 4% coming down. Right. And I showed you that with the Vanguard tool, the Vanguard Nest Egg Calculator. You can go there and just Google it if you missed the last video. How it essentially, in order to have the probability of not running out of money in retirement, you have to pull out, 3.5% or less to be able to have the probability of not running out of money in retirement. So how do we get these higher rates of return in retirement and having that cash flow come to us? That's what we're going to start talking about. So the current way that financial advisors are planning are really just using the rate of return power. They're saying, hey, let's take all your money, let's put it into stocks, bonds, real estate. You want your real estate guy? Okay, put it into real estate. And we're just relying on speculative nature of money. So the markets go up, your money goes up. Market goes down, your money goes down. If things change in the political arena, taxes change, all this stuff, everything is speculative. It's all focused on what if scenarios, right? And so that's a little unnerving, especially if you fast forward and you're in retirement. I want you to think, okay, just retired and you're at the golf club and you pull up your phone, you check the stock market, the bond market, and it's down. You're like, oh shoot, it's way down. You're like, okay, do I need to call my broker? Do I not need to go tee off and I need to do something here? It just messes with you in your head and your emotions. Right? And so we're going to talk about how we balance this. And so instead of just using rate of return power or interest rate power, we're going to use actuarial science. And there's a definition under there if you want to read it. But essentially, actuarial science applies mathematics and statistics so that you can create a proven result. Okay? So here's some examples of things that just get rates of return, right? So we have 401ks, IRAs, 403bs, your securities, stocks, bonds, ETFs, et cetera, CDs would be part of this retirement assets, real estate, businesses. And then things that use actuarial science are more like life insurance type products. And you're thinking, what, life insurance? And I'm not talking about term insurance. I'm talking about more permanent type of life insurance, like whole life insurance, universal life insurance. And that they provide death benefit and cash value. And we'll show you how this works into the plan. But you have to use these to create a smooth and a more powerful financial wealth proposition. So if you look at this, we want to balance between what we call accumulation power, that's the interest rate and the rate of return, and then actuarial science thing. Most people, their plan looks like this. Everything's in their 401k, or everything's in a brokerage account, or everything's in real estate or their business. And so they have this inefficient balance. Now the argue is that they're growing at a faster rate of return and accumulating faster in retirement, but it doesn't transfer smoothly to the other side, coming down the mountain, getting cash outside the other side of the mountain. So just go with me for a second. Let's say you have a business, you're a business owner, you grow your business, and at the end of retirement, you sell it for $5 million. Okay, great. Now what? How do you create a smooth use of assets all through retirement if you have a big lifestyle? Let's say you're used to living a lifestyle of $300,000 to $400,000 a year. It's a good question, right? So then there's other people that are super conservative and think, hey, I want only things in life insurance. and any things that are sure deal and guaranteed, and it becomes inefficient as well because they don't have as much of the accumulation growth. So this becomes inefficient. So we've got to create this balance, and that is the whole premise of my practice. Is I help people create this financial strength so they can have a balanced approach to growing their wealth. I want you to be able to go into retirement knowing that you're on solid ground. And even now, if you're in your 20s or 30s and the market looks volatile, you don't know what's going to happen with elections or wars or foreign events or currency changes or crypto or whatever. Like, if you have this balanced approach and you are set up, you are going to be so much more efficient. You're going to have so much more compounding that works for you because you started so early. So I commend you if you're watching this and you're in your 20s, your 30s, 40s, because you have a vision, you have a plan to be able to actually retire and know that you want those goals for safety and legacy and giving back. And so in our last video, I'm going to show an example of how the numbers work with what I'm proposing. And so I'm going to end the video here, and I hope you join me for video 4. If you want to make sure you want to get the notifications for that, just make sure you subscribe or hit the notification bell. And that way, when the next video pops up, you'll be able to go and watch that. So thanks for joining me here today.